What's up guys, my name is Kasper and you're watching CryptoGo's Experience channel. Today I'll talk why the blockchain and other cryptocurrencies are valued so much. Also, I will share my long-term pick that I believe will be valued the most in the future. In this video, I would like to address an argument that is on mind of every crypto opponent, which is basically a claim that cryptocurrencies have no value at all. However, this is not true, and I will try to explain that. Crypto coins have no intrinsic value or maybe a true asset value, but so it's dollar and most of other paper currencies. However, they have some other value that derives from the utility. So let's talk briefly about the asset value. Whenever you see a company and you will try to determine its actual value, you would base that on a perception of the true value of the company, including all aspects of the business in terms of both tangible and intangible assets. So if you would like to analyze any business and its value, you would probably look into balance sheet and you would say that including all the properties, inventory, and excluding maybe all intangible assets like patents, that the value of the company cannot be greater than the value of an asset in case of liquidation of the business. Let's go and look at my favorite example of Tesla, where the market price of Tesla is 12 times higher than its current asset value. As you can see, many would argue that Tesla is highly overvalued because it has such a big spread between book and the market value. However, this is not true because market price not only includes all the current assets, but also it takes into account future revenues that will flow into the company. Investors would say that the future expectations are very high towards Tesla, and this company can add a lot of value to the economy by, for example, not polluting as much as cars, using less scarce resources, which would save the environment and maybe some healthcare cost. Before we talk about the crypto coin, let's look at the dollar. Dollar is just a fiat money, which means that there is nothing that really backs it up, but maybe it's legal structure made by the government. This piece of paper, which is worth maybe a fraction of a cent to produce, tells you that you can store 100 worth of goods in it. Back in days, coins were produced from gold and silver. Later on, government would store percentage of the USD value, the market USD value, in the reserves as gold. But they have abandoned that system back in 1970s, and from then there is no real asset value in paper we call dollars today. However, this dollar has some other value that derives from scarcity and utility. Utility is the use of dollar as a medium of exchange, makes it easy to carry around, it is widely accepted by businesses and accessible by businesses and people, so people want to use it as opposed to bag of gold. Scarcity means we would value dollar depending on how little or how much of dollar is out there. Just think about it. If there is a normal supply of dollar on the market, then $100 would buy you 12 six-packs of your favorite beer. Now, imagine the supply is reduced by half. People and businesses would have to adapt to this new situation and the new supply of money. Now, $100 would buy you twice as much six-packs, making it 24 six-packs for you. Alright, so let's recap that. We know that the value of something derives from its use and utility. This can be drawn by the demand and supply, where the demand is how much of people want this particular asset because it gives them some utility. If this utility is priced high, then not many people want to have it. If it's relatively cheap to obtain that asset, then more people would like to have it. That's why demand is downward sloping. Supply is just a showing of how much of this good is out there. And if the price of the good is high, then businesses want to produce it more. This situation changes when this good is cheap and businesses don't want to produce as much because of low margins and profits. You may have seen this chart before of supply and demand, which is just an abstract way of showing those two forces and how the price of a good and quantity is found. This is a classic supply and demand model that works well when we talk about goods like beer. I'm not going to talk about it too much here, but I think you get the idea. In terms of crypto, you could say that people have some demands from the market, like maybe independence from third parties where the game might be rigged and costly. By rigged game, I mean that access to a free checking accounts for poor people or some other restrictions from using digital money. For example, where people without social security number or maybe felonies cannot use banking accounts. Also, people may demand privacy, where banks would restrict you from spending money on some other things. Of course, this might be a good idea when you think about illegal activities. But in some other more conservative countries, banks may restrict you from using money from sport betting or gambling. So where is your freedom of choice? Also, in terms of crypto, you may think how something online and digital can be limited to define the supply. You might be thinking most of the online resources are free because they are unlimited. Here, the creator of blockchain, Satoshi Nakamoto, has also created digital scarcity, which means that the supply is defined by the blockchain protocol and it cannot be changed. This means if you would like to change the supply of the protocol, you would have to change the protocol itself. And if this protocol is changed, then all the people that use it would have to agree on that, since there is no central authority. So let's briefly see how the supply of Bitcoin is defined and how we could draw it on the chart. Supply of Bitcoin is defined in such a way that with the creation of a new block that takes time every 10 minutes, 25 new Bitcoins are issued to the block creator. This reward is reduced by half every 4 years, and sometime in the 22nd century, there will be no more Bitcoin issues. This means that the supply of Bitcoin is fixed long term, and we can draw it by the straight vertical line because the quantity won't increase. Now think of some factors that can influence the demand, which is pretty much its use case, like form of payment, storage of value, or maybe privacy and independence from central banking. So let's say right now we have the price at this level, P0. Let's analyze the following scenario. Imagine that more businesses are about to accept Bitcoin and more people would like the privacy and independence aspects of this cryptocurrency. Or maybe they need Bitcoin to trade it for some other crypto. Since most of the exchanges don't accept fiat, then Bitcoin or Ethereum are the universal parity for those exchanges, which makes them very valuable for the speculators. So what happens? Demand is increasing to the left because more people demand it. Therefore, the value of Bitcoin can grow, and actually it is hard to determine what the true value is, because it is hard to put a value on the utility as opposed to a tangible assets. This is probably the reason why the price is so volatile recently. People don't really know what would be the true use case of Bitcoin in the future, but they have some expectations. Some people believe it will be widely used, making it very precious, and some truly don't. In this slide, I would like to talk about crypto versus fiat money like dollars. So as you know, money can be controlled by central banks. In this case, we have federal bank. Here, if Fed determines that there is not enough money on the market and dollars are hard to get, they can print out more and buy back if there is too much money on the market. This is particularly helpful in the case of recession, where people and businesses are struggling to access money, and banks can help by lowering interest rates so businesses can obtain cheaper loans. This will result in inflation, which means that the value of US dollars is dropping. I think you still remember the example of $100 and cases of beer. In normal situation, you could purchase 12 six-packs, and when there is more money on the market, your $100 would purchase maybe only 8 six-packs if the supply of money is increased by 50%. To understand that concept better, you can find a video in the description below. Here, the Bitcoin supply is predefined and we can't change it. This creates a deflationary mechanism, which makes it great investment instrument as opposed to medium of exchange, which just means that if the demand is growing, the value is growing too. This situation can have pros and cons. For example, this is good in case of early adopters because now they have more value stored in Bitcoin than before. For example, maybe they purchase it for $10 and now it's worth $10,000. Supporters of the network benefits too. If you were an early miner, you could be a millionaire because over time people stepped into the game of mining and it became very hard to compete for the rewards. You can compare this situation to a gold scenario, where people buy gold to store the value because of its limited supply. Now, since most of the gold resources were exploited, it is harder to mine it, and more people would compete for it because the value of gold is increasing. That's why some people call Bitcoin as a digital gold. This situation can be bad too, like people will not use it for spending but rather save it. This makes it less valuable form of payment and bad medium of an exchange. Therefore, it is only a storage of a value as of now, which is not the best use for blockchain technology, in my opinion. How can we get out of this situation to make it form of payment? Adoption and distribution aspects are probably the most important. Everyone have to adopt it. Like people would have to get paid in Bitcoin and be rewarded for what they have done in Bitcoin as well, which means that distribution is fair as opposed to what is happening right now. Just look at this chart. You will notice that there is a great amount of wallets that have just a fraction of a Bitcoin as opposed to some wallets, maybe 2 or 3 wallets that have 100,000 Bitcoins in it, which is pretty unfair for late adopters. Also, there is another problem that I would probably talk about later in different videos, but Bitcoin was first and the creators didn't anticipate such adoption in a short time, which results in the network congestion and high fees. Now we have a better protocols that can make more money and that can make more transactions per second. Just look at this chart that compares a few different networks and a few different solutions. So now we know where the value comes from. Let's talk about the adoption and let's try to determine which crypto solution would be first to win the mass adoption game. So in case of adoption, you might be thinking what coin would be adopted by masses and who will win the competition since we have so many coins out there. I personally believe that coins as a payment form have a long way to go till fully adopted. But this game looks a little bit different in case of smart contract platforms, where businesses can develop their decentralized application and get rid of third parties. I'm talking about protocols like Ethereum or Neo. In this competition, I believe first movers on the market have the biggest chances of being adopted by the masses. To explain that, I will talk about network effect. Network effect is a situation whereby a product or service gains additional value as more people use it, and it has to reach a critical mass to finally create more value than it costs to maintain that network, making the competition field for others very hard to compete, where it might be too costly for the competitors to outpace the leader. Think of social media. Would you use Facebook when only 30% of your friends are using it? Maybe, but you see more value in Facebook where more people use it. We have Google Plus platform, but nobody really wants to use it. In my opinion, Google Plus costs Google a lot to maintain, and it is just simply not worth it. But maybe they keep it as a part of diversification strategy. I might be wrong, but this is just my perspective. Maybe think of Snapchat, that it takes incredible amount of resources to run such a network, but it cannot generate profit as of now. Maybe if Snapchat gains more users, then this network will generate some revenues. To really learn the theory of a network effect and critical mass adoption as present on this chart, it would be very beneficial to read the history of internet protocol called TCPIP, which is a foundation of internet and end-to-end communication. Now TCP/IP defines the layers of internet, and currently some cryptocurrencies want to define layers of decentralization and smart contracts. TCP/IP wasn't the only proposal out there for this kind of communication. There were many others like OSI protocol, and many people even said that OSI was a better proposal, but it was proposed too late. Many businesses like AT&T and IBM have already adopted TCP/IP, and this was enough to reach the critical mass crossover. making it very expensive for others like OSI to implement their idea. You can read about it by going to the link I have provided in the description. As you see, the blockchain enterprise solution is still in early stage, but there is one player that has been adopted the most. Yes, it is Ethereum. Just look at this chart where all the smart contract protocols are issued. Also, Ethereum has a huge base of supporters, and many talented developers are working for them. I'm not saying that Ethereum has reached critical mass crossover point yet, but it is getting there. Closer every day. However, let's talk about some pitfalls of emerging tech. Sometimes when you build a network, you will run into problems like that you haven't realized before, like recent scalability issue. And when you have a network already built where everyone agreed to use it, it is hard to implement any changes to it. Those changes would most likely take a long time and cost a lot, which means that maybe it will be better to start from scratch. Like recently, Ethereum wants to switch from proof of work to proof of stake protocol to be more scalable and cheaper. However, this takes time and effort of developing team. There are other coins out there that are trying to tackle this issue, and they are building it from scratch. But they don't have enough interest from publicly, like Ethereum has right now. Or one of these solutions is Cardano and Neo, which are probably the biggest potential competitors for Ethereum. If Neo and Cardano can implement their network in a short time and gain enough interests, they can outpace Ethereum. That's it for the video. Thank you for watching it. I hope you like it, and if you did, you can check out my other videos on my channel. I'll see you soon in the next video.